Let's talk about inflation. Seriously. Because as we look towards 2026, it's not just some number you hear on the news. It's become a systematic distortion, kind of like a funhouse mirror that's warping everything from the profits of massive corporations all the way down to your own personal savings. And you know what? Understanding this distortion is absolutely the key to financial survival. So, let me kick things off with a question, especially for anyone in the business world. Your company's report comes out, an impressive 20% profit. Time to pop the champagne, right? Well, maybe hold off for a second. What if I told you that profit might be a complete illusion? This right here is the central problem we're going to unpack. You see, the economy we're in now is defined by something called sticky inflation. And yeah, it's pretty much as persistent and hard to shake off as it sounds. So to build a real strategy against it, you first have to understand its different forms. Professionals break it down into 3 distinct types, and each one requires a totally unique plan of attack. First up, we've got demand pull inflation. You can think of this as the good problem to have, in a way. It's a sign of a really strong, booming economy where everybody wants to buy stuff. But, too much of a good thing can cause overheating. This is usually the cue for central banks to step in and start hiking interest rates to cool things down a bit. But then, there's this one, cost push inflation. Now, for any manager, this is the one that keeps you up at night. It's so dangerous because it doesn't matter how much people want your product. If the cost of your raw materials, your energy, or your shipping suddenly spikes, your profit margins get squeezed. Period. There's nowhere to hide. And this brings us right to the third type, built-in inflation. You've probably heard of it as the wage price spiral. It is a truly vicious cycle. Prices go up, so workers, naturally, need higher wages just to keep up. Companies pay those higher wages, but then they have to raise their prices to cover the new costs. It just creates this feedback loop that central banks find incredibly difficult to break. So how does all of this actually mess with a company's bottom line? Well, this is where that distortion effect really hits hard. In a high inflation world, your historical financial data isn't just a little outdated, it's dangerously misleading. It can paint a false picture of success. And this, right here, illustrates the problem perfectly. Look, on paper, it's simple. You bought an item for $100, you sold it for $120. That looks like a nice, clean 20% profit. But when you go to restock that exact same item, its cost has inflated to $115. Suddenly, your real, spendable profit is almost gone. This is what we call a phantom profit, and it's created entirely by inflation. So what do? Well, smart companies are being forced to adapt, and fast. The old way of doing things, like a fixed annual budget, is basically dead. It's being replaced by more agile, rolling forecasts. Businesses are also getting caught in the working capital trap, where they need more and more cash on hand just to maintain the same level of inventory. And that great new project idea you have, it now has to clear a much higher hurdle rate just to get approved, because the cost of capital itself is going up. So how do you fight back against all this distortion? I mean, you can't manage what you can't see, right? Fortunately, finance professionals have developed specific accounting tools that are designed to cut right through that inflationary fog and show you what's really going on with the numbers. At its very core, it comes down to a simple but really powerful formula. This is how you take a cost from the past and translate it into today's dollars. You just take that historical cost and multiply it by the change in a price index between then and now. It's the basic engine that makes inflation accounting work. Now that formula powers 2 key methods. Think of them as 2 different lenses to see the truth. The first, current purchasing power, uses a broad index like the Consumer Price Index. It's perfect for showing shareholders the true value of their equity over time, but for making day-to-day decisions, managers much prefer current cost accounting. It uses the specific, real-world replacement cost of an asset, which gives you a much more realistic picture for operational planning. Okay, let's bring all this home, because this isn't just a problem for big corporations. The exact same principles of distortion apply to your personal wealth. The goal here is to shift your entire mindset from looking at nominal gains, that's the simple percentage you see on a statement, to focusing on real returns. That's your growth after inflation has taken its nasty bite. And believe me, the stakes are incredibly high. With inflation in crucial sectors like healthcare and education running at 8, 9, even 10%, your hard-earned money can lose half of its buying power in less than a decade. That is a staggering, terrifying erosion of your wealth. So, what does a smart, inflation-proofed portfolio even look like in 2026? Well, the strategy really rests on 3 main pillars. First, you have stocks, because strong companies have the power to raise their prices and pass costs on to consumers. Second, you want specific government bonds like TIPS or I bonds, because their value is directly tied to inflation. And third, sovereign gold bonds, which give you the safety of gold's upside plus a nice 2.5% interest kicker. Phew, we have covered a lot of ground, but this is a really deep topic, so if you want to continue your own analysis, I want to leave you with the professional-grade resources you can use to track and understand inflation just like the experts do. For global comparisons, the IMF data portal is unbeatable. If you want a really deep dive into the Indian context, check out the latest economic survey. The Corporate Finance Institute has fantastic, easy-to-understand technical guides. And for the best interactive charts on what the market expects inflation to do next, Fred from the St. Louis Fed is the place to go. And finally, one last crucial distinction that will help you make sense of all the news headlines. When you hear about inflation, you need to know there are two different kinds. There's headline inflation, which includes everything. That's the price shock you feel at the gas pump and the grocery store. But central banks, they make their big interest rate decisions based on core inflation, which actually strips out those volatile food and energy prices to get a better sense of the underlying trend. So we end right back where we began. Every single financial number in your life, from your company's balance sheet all the way to your own retirement account, is telling a story. And a key question you have to ask yourself in 2026 is this: are you reading the truth? Or are you being misled by the fiction of inflation?